Hello, welcome to LCG's preview for the week ahead. I'm going to discuss the start of the holiday season, the last Federal Reserve interest rate decision of 2018, and also the Bank of England and the Bank of Japan will meet for the final time this year. Before that, I'll run down the biggest events in the economic calendar. On Monday, there's Eurozone CPI for October. On Tuesday, we have the RBA meeting minutes and German IFO. On Wednesday, we have the UK CPI for November, Canadian CPI also for November, and the FOMC policy decision, as well as the Fed's latest economic projections. On Thursday, we have the Bank of Japan's monetary policy statement and press conference, followed by UK retail sales and the Bank of England's interest rate decision. Then on Friday, it's UK GDP for the third quarter, followed by US Q3 GDP, and US durable goods orders for November. Moving on to the top corporate results to watch this week. Patisserie Holdings report full-year results. Then Oracle and Red Hat report third quarter earnings on Monday. Carnival, Micron Technology and FedEx report Q3 results on Tuesday. General Mills reports its third quarter numbers on Wednesday. Then Sears, Accenture, Walgreens Boots Alliance, Conagra Brands and Nike report Q3 earnings on Thursday. So obviously it's been a pretty high volatility start to the typically more placid December month. So I think because of this high volatility, you've got to question, are we due an upsurge after the recent downsurge? I think that beggars the question, why have we had the volatility? Well, it's really the same thing that's been triggering it for most of 2018. The Fed is reducing its balance sheet. As a reminder, it's on schedule for $400 billion worth of reduction this year. So that's about 10% of the balance sheet, scheduled for another $600 billion next year. So we just don't have that buying support that we once did. So news is going to impact the market more heavily than it previously did. So then the question being, we've had a bit of a jump down. Will we get this last gasp Santa rally? I think whether that happens or not is probably more a factor of trading dynamics than the market news. The news will drive it, but it's really a question of whether we see some short covering. There's a good chance of that, but equally can't discount the possibility of another purge of the weak hands in the market. So, there are some people buying this market, but they can easily be flushed out with another drop in the prices. Equally, any push up over the last few days, and you could actually see anyone shorting the market, which is actually at very high levels right now. You could see them equally get wiped out and see the market jump a fair bit higher than current levels, even by the end of the year. So moving swiftly on to the Fed meeting, they should raise rates this time around. So November core CPI showed year-over-year increase of inflation by 2.2%. So that's slightly above the Fed's targets. So inflation, that box can be ticked. PMIs and retail sales, they're strong. So from that perspective of the economy, looking pretty good. There are some issues like the market volatility for one, dropping commodity prices, also a bit of a softening in the housing market. They're all concerns, but likely not enough to stop the Fed raising rates in December. But if we move forward from that, which is always the question mark, looking into 2019, markets suggesting there's going to be a pause for the first half of the year. So the next rate hike, not till sometime past June, possibly even sometime in the autumn. So whether that is true or not will largely rest likely on the economic forecasts that the Feds are putting out. The recent rhetoric from the Fed has been a bit more dovish, meaning not quite so bullish on the US economy, talking about some of the risks, talking about a potential slowdown, and also just interest rates coming close to the neutral rate, a rate of interest that's appropriate for the current economy. So that being the case, if there is some slightly expected slowdown going into next year, maybe we peaked at 4.1, 4.2% in Q2, and we're maybe looking at more like a 2% economy again in 2019, well, then maybe there isn't quite the reason for as many rate hikes. And that overall is, I think, probably a a weaker dollar environment if all that pans together. But we'll have to look out for these economic projections from the Fed to give us an idea where the dollar might be headed going into Q1, Q2 next year. Bank of Japan, it's always a bit of a surprise whenever there is some big change in policy. Oftentimes at the meetings themselves, nothing particularly gets done. I don't think, given the recent market volatility, given the recent flight into the yen because of its haven status, I don't think the BOJ probably in the mood to rock the boat at the moment. So even though they are moving towards raising their 10-year yield target, slightly looser policy, don't think they're going to be doing it at this stage, particularly in the same month that the ECB are also suggesting unwinding their policy and ending QE. Moving on to the Bank of England, so no change expected. In fact, no change in interest rates or no hike in interest rates expected until late 2019. Probably not a surprise given the uncertainty that we have around Brexit. Obviously, that should all be known by March of 2019. So good or bad result, however you perceive it, really we should be all done and dusted with that element of Brexit by 2019. Bank of England will have a better place for understanding where the economy is, where Brexit's taking it, and then should be able to give a bit more clear guidance. Maybe bring in the rate hike, maybe not, but at this stage, it's probably all going to be referencing the Brexit uncertainty. On that front, Mark Carney specifically has come under a fair bit of pressure here. Quite honestly, from our perspective, the forecast the Bank of England have put out in the case of a quote-unquote no-deal Brexit are extreme. In a hard Brexit, the UK will come under WTA rules. And so, yes, there will be higher trade barriers, there will be higher other costs. That could even mean that the UK falls into recession, but something like a 5% drop in GDP, that seems, again, extreme. And so far what we've seen is that the weaker pound is already cushioning the blow, and presumably a no deal would mean an even weaker pound. And then last but not least, the Bank of England Governor Mark Carney is scheduled to leave. So then probably not at this meeting, but moving forward, there is going to be some question mark over who his replacement will be and what that means for policy. Right, thank you very much for watching. Good luck trading this week. And if you want to see these videos as soon as they're released, please follow LCG on YouTube and social media.